Hi, my name is Apattanaik and I am an investment advisor at Sprott. The following is a recording of a Q&A I conducted with Rick Rule on the 6th of November 2020. The topic of our discussion was navigating a secular precious metals bull market. Secular bull markets can be very protracted, both in duration and in dimension, but they also tend to be punctuated with a lot of downside volatility. It is important to pay attention to the fundamentals that underpin the bull market to maintain your conviction through the volatility and importantly to remain invested through the cycle. It is also important to pay close attention to valuations as investment opportunities will morph over the course of a bull market. I discussed these points in more detail with Rick during our discussion. Rick, the topic of our discussion today is navigating a secular precious metals bull market. You've often remarked about how secular bull markets can be very protracted, both in dimension and in duration, but are also punctuated with a lot of downside volatility. The first question that I will ask you has two parts. You can answer the question in whichever order you prefer. The first part is a personal one and relates to how you invest your own money. Do you pay attention to cyclical volatility in a secular bull market when making an investment decision? And the second part of the question has to do with the elections. Do you view the outcome of the elections more as an event that will drive near-term volatility, or do you think it can affect the direction of this gold bull market in a more meaningful way?
So let's deal with the second part of the question first, which is quick. I don't see any particular difference between both parties in terms of their policy response to the economy. There would seem to be, unfortunately from my perspective, broad support among the voters and hence broad support among the politicians for debasing the currency and continuing the war by spenders on savers, which is specifically to say there would appear to be broad support for quantitative easing, which debases the currency. There would seem to be broad support for fiscal measures, which increase both the debt and the deficit. There would seem to be broad support, too, for very low, which is to say artificially low interest rates. All of those policy prescriptions are bad for the ongoing purchasing power of savings in traditional savings instruments and as a consequence are good for gold. In the near term, it may be that nervousness around a Biden administration would cause a retreat in general equities markets because the other policy prescriptions of Biden, which include income and wealth redistribution and in particular higher taxation, are not recipes for higher equities prices. So it may be that in the near term, fear around other aspects of economic policy that are more unique to the Democrats would spook folks about general equities. And in the near term, remember that gold stocks are stocks. And to the extent that you have a contraction in the general equities markets, in the very short term, you would have a contraction in gold equities markets too. Understand that I'm saying that this is a possibility, not a probability. I'm not smart enough to tell you. With regards to the first question, which is portfolio allocation, with the caveat that I can allow myself to own more gold equities than other people do because I work harder at understanding them, I tend to be inclined to keep a good position in gold equities and gold itself through the bull market. That's my current intention, precisely, Aditya, because of the factors that you have mentioned. I think it's important to note that the prior bull markets that have occurred in my career, there have been two of them, have been, 10 or 11 years in duration. I would suggest that we're 2 years into this one. And in terms of dimension, you know, figure in terms of the equity indexes to generate 5, 6, or 700% gains over time. What changes is the distribution of my portfolio through subsectors in the gold business.
I'd like to return to the fundamentals that underpin this bull market. I would urge everyone on this call to read Ray Dalio's writings on long-term monetary cycles. The debt deficits and interest rate world that we are in today are characteristic of the end of long-term monetary cycles. Dalio points out that the devaluation of currencies is typically what has occurred in the past at this point in the cycle. Rick, you've often talked about how these three conditions of debt deficits and interest rates need to reverse in order for this gold bull market to end. I'd be interested in your thoughts on the anatomy of this bull market so far and where you see it going next.
Well, I'm frankly, Aditya, intrigued that it took this bull market so long to get going. One really would have expected the bull market to begin in 2015, when it was very clear that the political establishment and the central banks intended to debase the currency. I suspect that faith in the current system was so strong. Faith in the equities bull market, a bull market which has gone back, albeit with some hiccups, for 30 years, and the bond market, which has gone on for 38 years, means that old habits, which is to say faith and buying the dips, died hard. And I agree with a lot of what Dalio said as to the reasons why one would own gold. Some libertarian economist, I forget which one, I think it may have been Hayek, in describing the United States in the 30s, said, you know, there's a lot of ruin left in the country that's great. And I suspect that that's as true today as it was then. So the circumstance that you described, which many gold adherents refer to as a reset, is something that, if it occurs, will occur only in very slow motion. Certainly, my belief is, for the reasons that we've talked about, that wind is in gold sails. My belief is, too, that if the current gold price holds up just where it is, I suspect it's going higher, that the income statements and the balance sheets of gold companies will continue to improve, and the gold stocks themselves will lumber higher. I wouldn't regard my beliefs as, of course, any sort of fundamental information, but I believe that it's important to take note of the current economic and policy circumstances and make adjustments to one's portfolio, just as it's important not to let the narrative associated with that govern all of your actions and let your portfolio get too lopsided.
On the topic of gold ownership, you've often alluded to gold being an under-owned asset class on a percentage basis relative to its 3-decade mean. Do you pay much attention to the discussions that are being had on the confiscation of gold or the nationalization of mines?
They are small concerns relative to other concerns. I hope the response I'm going to give doesn't sound too radical. But the truth is, people ask me about confiscation of gold, they ask me about confiscation of IRAs, all that type of thing. Well, I believe that concern over the perniciousness of government is a very good thing. I think one thing that we've learned in the United States is that it's easy for the politicians to steal by increasing marginal tax rates. It's easy for them to steal, too, by quantitative easing. It's easy for them to steal from the next generation by borrowing on behalf of this generation. Easier and, in fact, popular. I don't think that they have any need to steal your IRA, and I don't think that they have any need to steal gold, because to the extent that they steal your future, with quantitative easing, with deficit spending, and with artificially low interest rates, this form of theft is ironically popular. So my suspicion is, and it's just a suspicion, that fear of overt confiscation should be fairly low on an investor's agenda. Similarly, with regards to stealing gold mines, governments have learned that they don't have to steal the mine all at once. They can steal the mine by requiring greater social contribution, by increasing the tax rate, by increasing tariffs and duties, by changing workplace requirements. You don't have to steal all of the mine at once when you can steal it slowly. And I think that's what you need to worry about. Political risk is inherent in mining aditya because it's capital intensive. Once you've put the capital in place, you can't move it. And a mine becomes an extremely tempting target for a politician or for a populace.
And your view on swap lines?
They're probably my 20th greatest concern. What Marin Katusa, who is the sort of author of that thought, has said is that given the fact that most of the debt in the world is denominated in U.S. dollars, those countries that have access to swap lines or currency lines with the U.S. Treasury have the best chance of being able to service their debt. And as a consequence, you will have a lower cost of capital in those countries. A cost of capital is one of several factors that are important. And my suspicion is that focusing on cost of capital to the exclusion of, as an example, other fiscal terms, what the tax rates are, what the ring fences are, what the grade of the deposit is, what the size and tenor of the deposit is, and who the management team is, I would suggest, as I say, that Marin's concern about swap lines is something worth considering, but it isn't very high on my list of factors to consider before making an investment.
If we look across the landscape of financial asset classes, a narrative that has gathered momentum along with gold over the last 12 months is Bitcoin. Have you changed your opinion on cryptocurrencies such as Bitcoin?
No, I haven't. I think Bitcoin is a sort of a spontaneous floating abstraction, whereas fiat currencies are socially based floating abstractions. The thing that intrigued me about Bitcoin always was the possibility that it was a frictionless medium of exchange. But the truth is the extraordinary volatility of Bitcoin means that it isn't actually frictionless. It increases and decreases in price so rapidly that it becomes an inefficient medium of exchange, simply given that you don't know what you're really paying for an item that you buy using Bitcoin, nor does the merchant understand the value that's being received with regards to Bitcoin. A second objection to Bitcoin, I think, probably goes to the fact that one of its original utilities was anonymity, which is to say you didn't know who owned it. You didn't actually necessarily know who you were giving it to. You didn't have to, because the trust in the transaction was guaranteed by the system. As the proponents of Bitcoin and other forms of cryptocurrencies have attempted to broaden utilization of cryptos, what they have opted for is more and more regulation, which threatens to obviate the benefit that one might get from anonymity. In other words, it's becoming more and more anonymous. The third nervousness that you have is that if Bitcoin or other forms of fiat, other forms of crypto ever became more viable competitors to fiat, it would be a relatively simple measure for governments to outlaw it. And while this wouldn't cripple all transactions in cryptocurrencies, I think it would limit them to an extraordinary fashion. when they tried in various countries to make gold illegal, people just continued to make transactions that were traditional transactions in an illegal form. I believe that there is lots of room for cryptocurrencies for those who believe in them, probably with a different architecture, and I believe that there's lots of room for gold. But it's important to know that gold's use of money has to do specifically with the fact that it's not a floating abstraction. It isn't a promise to pay. It's payment itself. It has a value in and of itself. It's simultaneously a medium of exchange and a store of value.
The first part of this discussion has been about moving away from an asset class that is essentially losing its purchasing power. And yet cash offers a certain level of security and optionality if there are opportunities that become available. What is your view for investors in terms of them holding cash in their portfolios?
I think holding cash is absolutely critical, whether you hold it in your portfolio as Sprott or whether you hold it in some other fashion, like in a bank. Having cash, I think, is absolutely critical. Periodically, and no one can tell you when, equity and debt markets experience liquidity and trust squeezes. March of this year was one. Before that, of course, 2008 was one. September 11th brought on one. And in those circumstances, when liquidity disappears from the system and trust disappears from the system, assets go on sale. Having cash, that is, having liquidity when other people don't, means that you can take advantage of those circumstances rather than being taken advantage of by those circumstances. Aditya, it is very true that having cash savings means that on a yearly basis or a 2-yearly basis or 3-yearly basis, that the purchasing power of your savings is in steady decline. And I think you rightly described that negative real yield as an option payment. Having the cash gives you the ability and the courage to take advantage of periodic illiquidity in the system. And as a consequence of that, I think, unfortunately, that reasonably good cash balances are an absolute must.
I want to switch gears now and discuss where you see the most value today for resource investors. In the past, we've talked about how opportunities within a bull market morph over its course based on the flow of capital. Do you see value differently today than you did 12 months ago?
Definitely, I see valuation and market leadership morphing. At the very bottom of the spectrum, which is to say the 1,500 juniors worldwide, I would begin the discussion by saying stock picking here is paramount. And probably 80% of the juniors listed worldwide, which is to say 1,200 to 1,500, are absolutely valueless. Despite this, some of them have $150, $200 million market capitalizations. So it's absolutely critical if you're playing at the bottom of the the bottom of the quality trail, that stock selection be absolutely positively paramount. It's interesting to note that the best of the juniors are the ones that the market seems to like the least. In other words, the bottom of the quality pile is currently the most narrative driven, which means it's absolutely positively the most dangerous. The value that I'm seeing in the sector is in the middle of the market, the sort of $2 to $6 billion market capitalization companies. They may be single asset producers, which are rightly viewed as being more risky than multi-asset producers because of the lack of diversity of their earnings base. Or there may be other reasons for their lack of favor, simply perhaps because the small cap narrative isn't in place, while they also lack the size and liquidity which would drive institutional investors. I think, too, after 3.5 years of leadership, the Australians have lagged the North American producers. And I think there's real value among the Australian producers. I think that there is a lot of reason to shade one's portfolio towards takeover candidates because the valuation disparities that exist between the largest and most liquid companies and good companies that are smaller but less liquid will either be resolved in the market or resolved by takeover. And I think that that's a sort of a magical place in the market to be. But the truth is, Aditya, that the whole middle of the market, if the gold price holds here, doesn't rise, if the gold price holds here, will reprice in 2021. We're seeing so much cash flow through the income statements, not just among the big companies, but among the smaller companies. And that cash is piling up faster than it can be deployed. There are limited opportunities right now for reinvestments because there hasn't been much exploration going on for the last 10 years. Balance sheets are improving very, very rapidly because companies are paying down their debts with free cash. And one of three things is going to happen with that cash. It's going to be paid out, or some of it's going to be paid out by way of dividends. We're starting to see dividend increases. If valuations continue constrained, some of the cash would be used to buy back stock, which is good. And hopefully some of that cash can be reinvested in business activities that generate relatively high returns on capital employed. This is a wonderfully virtuous circle, and I feel real good about it. I need to say, too, Aditya, and this will likely be unpopular with some of the listeners on the call who are alpha seekers, but for people who are really, truly underinvested in gold, and that is most of the people in the United States, simply capturing bull market beta, simply capturing the increase in price that occurs over 10 years in the index is enough. So the idea that you take too much risk with too much of your portfolio, subject yourself to too much volatility, rather than concentrating a substantial part of your portfolio on the biggest and the best companies in the sector, is a mistake. I'm not saying, by the way, don't take a certain amount of your portfolio that you can afford some risk with, that you can stomach some volatility in, and particularly where you're prepared to either on your own or with your broker or both study and work hard on the names that you buy. I've said many times that all of the money that I personally now invest prudently, I made by speculation. But it's important that people note that I have for many, many, many years worked 55, 65 hours a week precisely on this. Most people have lives, so they can't afford to be as speculative or to own as many names as I do because they don't have the time and the expertise to play the game as hard as I do.
Yes, well, thank you, Rick, for your comments and for the insights. These are indeed interesting times in the financial markets today. The stimulus certainly seems to be counteracting the deflationary forces that are in the market. I think it's important for folks to pay attention to the devaluation of fiat currencies. Rick, before we wrap up this discussion, are there any closing comments that you would like to end with?
Actually, I do, if you'll indulge me. I do. I have something that I want to leave people with regards to the bull market in precious metals. And that is simply a narrative from me, I guess, about why I believe that this bull market is the real thing, but also some thoughts about when one should exit the bull market. Throughout this call, I have talked about the fact that gold bull markets, if we're in a real one, are of substantial duration and dimension, 10 years, 500% or something like that. There's no guarantee. that this one will be like the last one, but a study of history is useful nonetheless. Turning away from history, one needs to look at the fundamentals. And the fundamentals behind precious metals are, from my point of view, extraordinarily strong. Precious metals have performed well throughout history at various times, but the most important determinant has been society's faith in the purchasing power of their savings, denominated in traditional savings instruments. And I would suggest to you that that faith is waning, and it's waning for good reasons. It's useful to go over them. The first is quantitative easing, which is by definition debasing the currency, making existing currency units worth less due to lack of scarcity. The second is debt and deficits. The numbers just in the United States are mind-boggling. $27 trillion in on-balance sheet liabilities, with the net present value of off-balance sheet liabilities, things like Social Security, Medicare, Medicaid, Environmental Trust Fund, Pension Benefit Guarantee Board, exceeding $160 trillion, completely unserviceable from current revenues, given that current revenues add $3 trillion a year to the deficit. So debt and deficits, which I expect to continue for a while, are bad for the country and good for gold. The most important is negative interest rates. Interest is the compensation that savers receive for foregoing consumption on behalf of others, but they also serve to protect investors from the erosion of their purchasing power and also from the deteriorating credit quality of the borrower. Given debt and deficits, one needs to be increasingly concerned about the credit quality, as an example, of the issuer of U.S. 10-year treasuries. There are two more factors that I think are important. The first is the fact that gold is, despite all of its advantages, and I use gold as a proxy for precious metals, under-owned. We've talked about this a lot, but the market share of precious metals related assets relative to other savings and investment products in the United States is less than 0.5%. The 3-decade mean market share is between 1.5% and 2%. You don't have to have some great reset. You don't have to have a collapse of the U.S. economy or a collapse of the U.S. dollar for gold to do well. All you need is for the market share of precious metals and precious metals related assets to go to or above historic norms. That is to say, a reversion of the mean. Finally, and this is related to artificially low interest rates, institutional investors worldwide manage about $100 trillion in assets. And their traditional mantra has been 60% equities for growth, 40% bonds for current income and for safety. The idea being, in a strong economy, interest rates rise, so the bonds fall a little bit, but the stocks rise very, very well, compensating you. In a weak economy, as the interest rates decline, the capitalized value of those cash flows increases so that the bonds do well even as the stocks fall. The difficulty with regards to negative real interest rates is that the current yield on the bonds goes negative. In other words, there's a carry associated with it. And at very low interest rates, the idea that you can get a capital gain from sub-zero interest rates over time goes away, which means that in periods of negative real interest rates, you begin to see disintermediation, that is to say, disinvestment from bond portfolios into other savings assets. I'm not suggesting that you're going to see $40 trillion go away from bonds and into gold. What I am saying is that you are going to see increasing participation in the gold market from existing institutional debt holders. Now, using these factors, when can we or when should we begin to be concerned that the gold bull market is long of tooth? And I suggest you do it by looking at those very factors. If the United States were to go 18 months or 2 years without quantitative easing, if they began to shrink rather than expand the Fed balance sheet, you would begin to go some way towards strengthening rather than weakening the U.S. dollar. So if we had a period of time where the Fed balance sheet shrank and we weren't doing quantitative easing, that would reverse one of the conditions that I think is a condition precedent for the gold bull market. A second goes to debt and deficits. If we had a situation where the budget deficit as a percentage of GDP was substantially below GDP growth in the economy, let's say where the debt was less than 1% of GDP while the economy was growing at 1.5% a year, that would suggest that we could at least grow the economy into the position where we wouldn't need to increase the debt and we could service the debt. So that's a number I would look at very carefully. But I think the most important number that one needs to look at is the real interest rate. Traditionally, going back over 40 or 50 years, the U.S. 10-year Treasury has had something like a 200 basis point positive real yield. Given that the Congressional Budget Office says that the currency is depreciating in value by about 1.6% a year, you would need a gross yield on the U.S. 10-year Treasury of 3.6, 3.7, or sort of 4 in order for there to be a reversion to mean in terms of real yield. So to the extent that you saw in the U.S. 10-year Treasury 200 to 300 basis point real yield, you would need to be concerned about the continuation of the gold bull market. Some of that will be reflected, or might be reflected, I guess, in the overall ownership levels of gold. And unfortunately, I don't know how to obtain the statistic, although I'm looking at it. When the estimated percentage of precious metals related assets goes above historic norms, which is to say 2% of savings and investment assets in the United States, then gold is no longer underowned. I would be fine if precious metals were 3 or 3.5% market share. In other words, I would be okay with them being overowned as a percentage of gross savings investment assets countrywide if all of the other conditions precedent to a precious metals bull market stayed intact. But I think it's important at the beginning of a bull market that one, first of all, participates, because these are generally of long duration and good dimension. I think it's important, too, that one conditions oneself to understand that these assets are both cyclical and volatile, and understanding in a quantitative fashion when one must begin to exhibit caution is critical. And I would encourage everybody to think for themselves about what I've just said. And if you need some help walking through it, of course, contact Aditya. We've thought long and hard about this. It's what we do for a living.